the Monetary Policy Committee met on the 20th and the 21st of March 2017 against the backdrop of persistent uncertainty in the global economy stemming from economic and socio-political developments around the world. On the domestic front, while the fourth quarter 2016 GDP figure was better than the last two consecutive quarters, the economy remained in recession with inflationary pressures continuing unabated. These adverse external and domestic conditions continued to complicate the policy environment. In attendance at the meeting were 10 members of the committee. The committee assessed the global and domestic economic and financial environments during the first quarter of 2017, as well as the outlook for the medium term. The global economy witnessed greater momentum during the fourth quarter of 2016, facilitated by gains in both developed, emerging markets and developing economies, which propelled global GDP growth to 2.7% year-on-year during the fourth quarter, a 0.2 percentage points improvement over the third quarter of 2016. In spite of this development, the external environment continued to be plagued by political, economic and financial market uncertainties, with defining issues being the Brexit, the growing protectionist and anti-globalization sentiments, divergent monetary policies of the advanced economist central banks, and volatile commodity price movements. The protectionist stance of the new U.S. administration could impact negatively on global trade and economic recovery. The Monetary Policy Committee noted the slip in oil prices against the backdrop of fears of a supply glut, fueled by increased activities in the U.S. shale oil production, which threatens to undermine the rebalancing effects of the last OPEC decision to cut output. The committee also noted the increase in the target range of the U.S. Fed funds rate at the last meeting of the FOMC and the potential spillover effects on global capital flows and interest rates, especially given the still tepid global economic activity and weak demand. Challenges in the emerging markets and developing economies persist as they struggle with strong headwinds from low commodity prices, rising inflation, currency volatility, receding real income, and capital reversals. Overall, the committee noted the dampening effects of economic stagnation and uncertainty on global trade and investments. In spite of these constraints, however, the IMF estimates that the global economy will witness a slight improvement in growth from 3.1% in 2016 to 3.4% in 2017. Global inflation continued its moderate but steady rise against the backdrop of improved oil prices and depreciated currencies in several emerging markets. Amongst the major advanced economies, the U.S. Fed maintained its tightening stance with a further upward adjustment in March 2017. Meanwhile, the Bank of Japan, the Bank of England, and the European Central Bank maintained the soft policy stance at their most recent meetings. Domestic output developments. Data released by the National Bureau of Statistics in February 2017 showed that the economy contracted marginally by 1.3% during the fourth quarter of 2016, effectively remaining in recession since the second quarter of 2016. Overall, in 2016, the economy contracted by 1.51%, with the contraction during the fourth quarter being the least since second quarter of 2016. The non-oil sector grew by 0.33% during the fourth quarter, largely reflecting the slowdown in the agricultural sector, which decelerated to 4.03% during the fourth quarter of 2016 from 4.54% recorded during the third quarter of 2016. The committee remains of the conviction that fiscal policy remains the most potent panacea to most of the key negative undercurrents, that is, stunted economic activity, heightened unemployment, and high inflation. In spite of the recent moderate recovery in oil prices, the committee approached developments in commodity prices cautiously. It noted that the era of high oil prices was over, thus making diversification away from oil more imperative today than ever before. Committee noted that money supply contracted by 5.73% in February 2017, annualized at a 34.38% in contrast to the provisional growth benchmark of 10.29% in 2017. Similarly, net domestic credit contracted by 1.41% in February 2017, annualized to 8.46%, being significantly below the 17.93% provisional growth benchmark for 2017. Likewise, net credit to government contracted at an annualized rate of 49.74%, representing 82.86% below its program target of 33.12%. In effect, all the major monetary aggregates contracted by the end of February and underperformed their program provisional benchmarks for fiscal year 2017. Headline inflation year-on-year, however, declined for the first time in 15 months, dropping by 0.94 percentage points to 17.78% in February, from the 18.72% recorded in January 2017 and 18.55% in December 2016, seemingly reversing the monthly upward momentum recorded since January 2016. The moderation in headline inflation in February 2017 reflected base effects as well as decline in the core component, which fell by 1.90 percentage points from 17.90% in January to 16.0% in February 2017. The food index, however, rose to 18.53% in February, a 0.71 percentage points increase over the 17.87% recorded in January 2017. Committee similarly observed a continuous upward trend in the month-on-month inflation rate in February, having slightly moderated between December 2016 and January 2017. It noted the sustenance of the structural factors mounting pressures on consumer prices, such as high cost of power and energy, transport and production factors, as well as rising prices on imports. Nevertheless, the committee remains optimistic that the adopted policy stance and other ancillary measures directed at improving the agricultural and other relevant sectors of the economy will combine to restart growth and drive down prices in the short to medium term. Money market interest rates moved in tandem with the level of activity in the banking system. While rates were relatively stable during the review period, the interbank core rate opened at 6.25% on January 25, 2017 and closed at 13.14% on February 28, 2017. However, the average interbank core rate rose to 100% and 133.84% on January 21 and January 23, respectively, following the withdrawal of liquidity from the banking system through the sale of foreign exchange worth 137 billion naira on February 21, 2017. Committee noted the decline in the equity segment of the capital market as the all-share index fell by 3.07% from 26,036.24 on January 21, 2017 to 25,238.01 on March 10, 2017. Similarly, market capitalization decreased by 2.68% from 8.97 to 8.73 trillion naira during the same period. Nevertheless, the end December 2016, the capital market prices fell by 3.12 and 3.063% respectively, reflecting the challenges still confronting the economy. Total foreign exchange inflows through the CBN decreased by 8.87% in February 2017 compared with the previous month, as foreign exchange market receipts were significantly lower. Total outflows also declined by 7.32% during the same period. The committee noted that the average Naira exchange rate remained stable at the interbank segment of the foreign exchange market during the review period. The outlook and the risks. Available data and forecasts of key economic variables, as well as the newly released federal government's economic recovery and growth plan, indicate prospects of output recovery in 2017. The committee expects that the implementation of this plan, the new foreign exchange policy, as well as the current effort by the federal government to restore peace in the Niger Delta region, will help revive economic growth and stabilize prices. The committee identified the downside risks to this outlook to include the possibility of a slower than expected rate of global economic activity, tight monetary policy stance by the US Fed, resulting in strengthening US dollar and lower oil prices. The committee's considerations. Committee re-evaluated the implication for Nigeria of the continuing global uncertainties as reflected in the unfolding protectionist posture of the United States and some European economies, sustenance of the OPEC-Russian agreement to cut oil production beyond July 2017, sluggish global recovery, and the strengthening US dollar. Committee also evaluated other challenges confronting the domestic economy and the opportunities for achieving price stability conducive to growth in 2017. In particular, committee also noted the persisting inflationary pressures, continuing output contraction, high unemployment rate, elevated demand pressure in the foreign exchange market, low credit to the real sector, and weakening financial system indicators, among others. Nonetheless, members welcomed the improved implementation of the foreign exchange policy that resulted in the Naira's recent appreciation. Similarly, committee expressed satisfaction on the release of the Economic Recovery and Growth Plan and urged its speedy implementation with clear timelines and deliverables. On the strength of these developments, committee felt inclined to maintain a hold on all policy parameters. Nevertheless, committee noted the arguments for tightening policy, which remain strong and persuasive. These include the real policy rate, which remains negative, upper reference band for inflation remains substantially breached, and elevated demand pressure in the foreign exchange market. The reality of sustained pressures on prices, here we mean consumer prices and the Naira exchange rate, cannot be ignored given the bank's primary mandate of price stability. It noted that the moderation in inflation in February was due to base effects as other parameters, particularly month-on-month CPI, continued to rise. However, tightening at this time would portray the bank as being insensitive to growth expected prospects. Also, the deposit money banks may easily reprice their assets, which would undermine financial stability. Besides, the committee noted the need to create binding restrictions on growth in narrow money and structural liquidity, and the imperative of macroeconomic stability to achieving price stability that is considered conducive to growth. The committee also considered the argument for loosening the stance of monetary policy, noting its desirability in stimulating aggregate demand if credit increased with lower rates of interest. It noted the argument that loose monetary policy was capable of delivering cheaper credit, making it more attractive for Nigerians to acquire assets, thus creating wealth and stimulating aggregate spending and confidence by economic agents, which will eventually lead to lower non-performing loans in the banking system. However, the counterfactual argument against loosening was anchored on the upward trending month-on-month inflation and its impact on the exchange rate. Loosening will thus worsen the already negative real interest rate, widen the interest rate spread, and reverse the positive outlook for the current account position. On outlook for financial stability, committee noted that the banking sector was becoming less resilient as a result of the adverse macroeconomic environment. Nevertheless, the Monetary Policy Committee reiterated its resolve to continue to pursue financial system stability. To this end, the committee enjoined management of the bank to work with deposit money banks to promptly address the rise in NPLs, declining assets quality, credit concentration, and high foreign exchange exposures. The committee also noted the benefits of loosening at this time, which will be in line with the needs of fiscal policy to restart growth. The MPC, however, noted that loosening would exacerbate inflationary pressures, worsen exchange rate, and further pull the real interest rate into negative territory. Since interest rates are sticky downwards, loosening may not necessarily transmit into lower retail lending rates. The committee noted the consecutive positive contribution of agriculture to the gross domestic product during the fourth quarter of 2016, a development partly traceable to the bank's interventions in the sector. The committee remains optimistic that, if properly implemented, the newly released Economic Recovery and Growth Plan, coupled with innovative, growth-stimulating sectoral policies, would help fast-track economic recovery. Committee's decisions. The committee, in consideration of the headwinds in the domestic economy and the uncertainties in the global environment, decided by 9 out of 10 members to retain the NPR at 14% alongside all other policy parameters. 1 member voted to raise the NPR. In summary, the MPC decided to 1. Retain NPR at 14%, retain the CRR at 22.5%, retain the liquidity ratio at 30%, and lastly, retain the asymmetric corridor at plus 200 and minus 500 basis points around the NPR. I thank you for listening.
Thank you, Mr. Governor. Distinguished ladies and gentlemen, we have heard the communique number 112 of the MPC of the Central Bank of Nigeria. Our house rule says we limit our questions, comments to the subject matter of issues, especially raised in the communique. We will appreciate if we respect that understanding, please. Now, for your questions, please come close to this place. Your name, your organization, and your question. Let's ask one, please. I beg you, one. Just one question per organization, so we can try to cover as many as possible. Thank you.
Mr. Governor, good afternoon. My name is Udo. I work for Premium Times. So my question has to do with the interventions that the CBN has been doing in the past few weeks until the National Economic Council directed the CBN to review the floating forex policy. The Naira was tumbling all over the place, crashing almost to $522. Now, when the CBN decided to intervene, we have seen that the value of the Naira has significantly improved. But some critics are saying that this policy seems not very sustainable. What do you say to them? And so can you take a chance to at least review the interventions to know exactly how does it impact the market and the level of the Naira? Thank you.
Mr. Professor, good afternoon, sir. My name is Onyema Machara for Business Daily newspaper. We have noticed that the official exchange rate, the interbank rate, you have not put it at 307 naira a dollar, and that is this afternoon on your website. And this against the 305 naira that we have seen for a while now. So what is actually happening? Is that a deliberate policy to kind of weaken the Naira at the interbank market so that we'll begin to see some form of closing of the gap really between the official and the parent market rate? And how far is the CBN ready to go with that weakening, if that is actually what's happening?
Thank you. Okay, that's all. This is a good day. Any more questions? I will ask if you don't ask.
Let me ask. Since the governor said that, thank you, Mr. Godwin, but I also the Guardian newspaper. So I'd like to thank you for the successes recorded. At least we can see that the inflation is trending, and I want to believe that it's as a result of the synergy between the fiscal and monetary authorities. And I also listened to you say that it's very, very key that fiscal policies should be really aligned so that we can upscale growth. But sir, I'm really shocked this afternoon, sir, and that's my concern here, which I'm trying to raise here. My colleague at the National Assembly just mentioned something that the executive is proposing that the powers of the CBN governor or the bank itself should be curtailed. So some of the powers that the bank should be checked. I don't know if this is arising from the meeting that you had at the weekend. Maybe you want to tell us what really happened.
Thank you. I think the governor can now take the questions.
Thank you very much. The FX interventions and then the issue that as a result of the FX interventions that the rates have started to come down. And the question is whether this policy is sustainable, and how have the interventions really impacted on reserves and positive effects. But basically, the point is that the NEC did not direct, because I've heard about NEC directing and all that. The central bank made a presentation on the Nigerian economy and the FX market to the NEC. And the NEC thereafter advised that we should look into all the issues that were discussed on the foreign exchange market. But of course, before then, we had started to see the rising trend in the exchange rate, particularly at the parallel market, and we had taken a decision that there was a need to reverse the trend. And that is the reason we specifically started the FX interventions. And I am happy indeed very gratified that those interventions have proved very positive. We've seen the rates now converging, and we are strongly optimistic, very, very optimistic, that the rates will converge further. In terms of sustainability, I think it's important for us to say that reserves at this time still trending upwards to almost close to $31 billion as I speak with you. And the fact that we have done this consistently for 4 to 5 weeks should tell everybody, or those who doubt the strength of central bank to sustain this policy, for me to say that they are taking a risk and they will lose in this bid to want to place the wrong bet on the direction that we are going. The direction is that there is a determination to see to the convergence of those rates. And with what we have seen so far, we are very optimistic that those rates will converge. And all the elements in the foreign exchange, on the flagging foreign exchange market, will no doubt be implemented. It is a program, and I am happy to say that that program is on course. We are happy that it's looking good, in fact beyond our expectation. And those who still remain on the sidelines, doubting the level of CBN's ability to sustain this policy, that they are on the wrong side of the bet. Second, there is what Onye talked about, the fact that, that the rate had moved from 305 to 307. It had nothing to do with any adjustment. The market is not expected to be fixed. The market will move, sometimes based on trends, from 305 to 304 or 304.5 to 306 to 307 and down. It is not meant to be a fixed market. It's supposed to be sort of a floating market, but it must float within a particular range. So it has nothing to do whether it's an attempt to further weaken the currency. Well, the last question on the issue bordering on an amendment of the CBN Act, I've always said that the powers to make, powers to abrogate, powers to amend laws rest with the National Assembly. But I am very optimistic that the National Assembly, in an attempt to either make or abrogate or amend a law, will, in their wisdom, use world's best practices in an attempt to determine the best course of action, not just for central bank, but also for Nigerian economy. Thank you very much.
Thank you. And thank you all for coming up. See you in 2 months.